Mortgage fraud is crime in which the intent is to materially misrepresent or omit information on a mortgage loan application to obtain a loan or to obtain a larger loan than would have been obtained had the lender or borrower known the truth. In United States federal courts, mortgage fraud is prosecuted as wire fraud, bank fraud, mail fraud and money laundering, with penalties of up to 30 years imprisonment. As the incidence of mortgage fraud has risen over the past few years, states have also begun to enact their own penalties for mortgage fraud. Mortgage fraud is not to be confused with predatory mortgage lending, which occurs when a consumer is misled or deceived by agents of the lender. However, predatory lending practices often coexist with mortgage fraud. Predatory lending describes unfair, deceptive, or fraudulent practices of some lenders during the loan origination process. While there are no legal definitions in the United States for predatory lending, an audit report on predatory lending from the Office of Inspector General of the FDIC broadly defines predatory lending as imposing unfair and abusive loan terms on borrowers. Though there are laws against many of the specific practices commonly identified as predatory, various federal agencies use the term as a catch-all term for many specific illegal activities in the loan industry. Predatory lending should not to be confused with predatory mortgage servicing, which is used to describe the unfair, deceptive, or fraudulent practices of lenders and servicing agents during the loan or mortgage servicing process, post-loan origination. One less contentious definition of the term is the practice of a lender deceptively convincing borrowers to agree to unfair and abusive loan terms, or systematically violating those terms in ways that make it difficult for the borrower to defend against. Other types of lending, sometimes also referred to as predatory, include payday loans, credit cards or other forms of consumer debt, and overdraft loans, when the interest rates are considered unreasonably high. Although predatory lenders are most likely to target the less educated, lowest incomes, racial minorities, the elderly, victims of predatory lending are represented across all demographics. Predatory lending typically occurs on loans backed by some kind of collateral, such as a car or house, so that if the borrower defaults on the loan, the lender can repossess or foreclose and profit by selling the repossessed or foreclosed property. Lenders may be accused of tricking a borrower into believing that an interest rate is lower than it actually is, or that the borrower's ability to pay is greater than it actually is. The lender, or others as agents of the lender, may well profit from repossession or foreclosure upon the collateral. Predatory mortgage servicing. Predatory servicing is a pejorative term used to describe abusive, unfair, deceptive, or fraudulent mortgage servicing practices of some mortgage servicers during the mortgage servicing process. There is no legal definition in the United States for predatory mortgage servicing. However, the term is widely used and accepted by state and federal regulatory agencies such as the Federal Deposit Insurance Corporation, Office of Thrift Supervision, Office of the Comptroller of the Currency, Federal Trade Commission, and government-sponsored enterprises such as Fannie Mae and Freddie Mac. While there are no specific laws against predatory mortgage servicing abuses, there are local, state, and federal laws against many of the specific practices commonly identified as predatory mortgage servicing abuses, and various state and federal agencies use the term as a catch-all term for many specific illegal activities in the mortgage servicing industry. Predatory mortgage servicing is not to be confused with predatory lending, which is used to describe the unfair, deceptive, or fraudulent practices of mortgage brokers and lenders during the mortgage loan origination process. Predatory mortgage servicing typically occurs on subprime, alter, scratch and dent, and toxic mortgages that are being serviced by special or default servicers or servicers and lenders that are financially in trouble. However, predatory mortgage servicing has been exposed on all types of residential mortgage, including what is called a paper notes. There are many motives for predatory servicing practices, and a report titled Misbehavior and Mistake in Bankruptcy Mortgage Claim by Catherine M. Porter, professor of law at the University of Iowa, details the effects and damages caused by servicing abuses. The landmark report has been cited by several state and federal judges in decisions related to predatory mortgage servicing and foreclosure practices. In mortgage securitization transactions, the mortgage servicer forwards the borrower's payment of principal and interest to the certificate holders, investors, of the special securitized trust that owns and holds the promissory notes secured by the mortgages and deeds of trust. The mortgage servicer, however, is allowed to retain late fees, BPO fees, inspection fees, and other fees charged or assessed to a borrower's account in addition to the fee income. The servicer is allowed to retain the net liquidation proceeds of any foreclosure sale, net after foreclosure expenses and principal balance to investors. This provides an incentive to unscrupulous servicers who aggressively interpret mortgage documents to add additional fees to a borrower's mortgage account. Many times, the additional fees added on create an event of default, allowing the mortgage servicer to foreclose on the property. This practice is commonly referred to as manufacturing a default or manufactured default.